You can't control what the future holds, but you can take control of your investments with principle. Whether your goal is to enjoy a comfortable retirement or to secure your financial legacy for future generations. After all, your future and aspirations are worth investing in. That's why we offer a wide range of fund options that gives you global and local exposure for better returns. With more than 142 years of global investment experience at your fingertips, you can take full advantage of opportunities to build your wealth. And we make it easier for you to manage your investments with our enhanced digital solutions. Now you can easily buy, redeem and switch your investments at your own convenience with our easy-to-use online investment portal. Never miss the right opportunities to invest with cash or iInvest. As you build your legacy and aspirations, we will be by your side to help you secure the future for you and your loved ones. Start taking control of your investments with principle today.
Assalamualaikum and hello everyone. I am Siti Nadazari, your moderator for this year's first webinar session, where we will be discussing the outlook for 2023, inflation, China, and desynchronization. Before we begin, I would like to share a couple of house rules. This webinar will take approximately 30 minutes, and after that, there will be a 15-minute Q&A session. If you have questions for our presenter, please drop them in the comment box, and we will address a few questions with the most likes at the end of this session. Do stick around until the end because we'll be sharing a special offer for you. All right, so now I'd like to introduce our presenter, Mr. Jeffrey Chong, Head of Equity, Absolute Return Strategy, International Investment from Principal Singapore. Hello, Jeffrey. Thank you for joining us tonight. I'm sure the audience is excited to learn more about your vast experience in the financial industry. Appreciate it if you could share with us a quick intro of yourself before your presentation. Over to you, Jeff.
Hello, everyone, and hello. Thank you, Nadia. So I'll just start with a very brief introduction of myself. Just to share with you, I've been working with in the financial industry for the last almost 3 decades. A large part of it in the financial, or rather in fund management and managing funds, managing mutual funds or equity funds, particularly in the Asia Pacific region. And for the last 10 years or so, I'm proud to be a manager for Principal Asset Management, managing Asia Pacific equities. So let me start by sharing my screen. Let me do that. Okay, I hope you guys can see that. All right, so the title for today is Inflation, China and Desynchronization. But before we do that, let me start by setting the backdrop for, for the markets or for the issues that we are seeing today. Right, so we had a very difficult market in 2022, as you all know. Whether it is in global equities or developed market equities, Asian equities, or even bonds for that matter. And that is due largely to, the high inflation, particularly where we saw acceleration of Fed tightening. And then, of course, there was fear of recession coming into the later part of 2022, and then importantly for Asia, or significantly for Asia, China's weak recovery. So my main messages today is this, all right. Market correction in Asia for risk assets, we can safely say is over. And that is primarily due to or being led by China's prioritizing growth in 2023, and it's has decisively shifted its policies to growth. And China, of course, is leading Asia out of its malaise the last couple of years. For this year, we think earnings downgrades in Asia has already been very significant in our minds. Within Asia, fund outflows have also been very large. Expectations are low. Valuations are also relatively cheap. On the other hand, for US, inflation remains relatively high, but we think it's unlikely to get worse, and it is probably has passed its peak already. And with that, we think that monetary policy tightening is also close to its peak. The other fear is that developed economies could face recession in 2023. So therein lies the desynchronization of the global economies that we are experiencing right now. So we had a correction over the past 20 months. Now, this chart here essentially is to show you the correction of equities for the past 35 years. So as you can see here, the green dotted line here is the latest correction, and it is by far the longest that we've experienced. It is also one of the deepest that we've experienced, bar the global financial crisis and the Asian financial crisis. And in most cases, when we do see a correction, when we see that the correction is over, subsequently, the next 12 months, the returns have been positive and significantly positive, with the exception of two cases, as you can see from here. Right, the first example is back in 2000 during the dot-com bubble. That was down 20% in the next 12 months, but that is also due to an interest rate hike cycle in the US. The other one, of course, it's back in during the global financial crisis back in 2007 to 2008. And that in large part was due to the banking sector seeing a crisis, and the stability was being questioned as far as the financial system is concerned. So that's why we had that negative return for the next 12 months. But in this case, and for this episode that we are seeing right now, we do not have these circumstances. So Asia, it's going to be led by China, as I mentioned. I think China is going to recover relatively strongly in 2023. In fact, China's Economic Work Conference, which is held during December, in late December, and helmed by China's top leaders, has indicated that its top priority is to bring China's growth back to its potential, which in this case is more than 5%. So what have they done? Essentially, they have aligned all policies for the first time in 3 years, whether it's COVID, economic or regulatory policies, it's now all in favor of growth. So the first thing that they have done, one of the most significant things that they've done recently is, of course, that they have reopened, and they've reopened much faster than expectations. And of course, unfortunately, that has led to a surge in infections, leading to some near-term contraction in the economy, which we do expect in the fourth quarter of last year. But nonetheless, this accelerates the herd immunity process. And in fact, the latest mobility data that we are seeing back in late December, in fact, there are other indicators as well that started to improve quite significantly, indicating that more cities are recovering very quickly. The other thing that is very significant is that China has released many policies, including this so-called 16 measures back in November to support the property sector. And we think that is very significant to stabilize the property sector, which in turn help to support the economy. And so what we have done as far as our portfolios are concerned is that we are now overweight China. We are positive largely on reopening plays, domestic consumption, and tourism-related names. Okay, so this chart is just to show you that since they've opened, especially towards the right-hand side of the chart, you can see that we saw some dips once it reopened due to a surge in infection. But since late December, the index have recovered quite nicely. All right. So one of the necessary conditions for a recovery is that there has to be a strong credit impulse. In this case, you can think of credit impulse as loans or loans growth, and it is a necessary condition for a recovery in the economy. So for 20, as you can see, the red line here, it was down since early 2021. It turned down all the way to negative back in 2022, and it started to turn upwards, and then it became positive in late 2022, and it is now in the positive territory. And so it is suggestive that the economy could it's supported by a easier monetary and financial condition. Okay, so I've mentioned that property is a very important part of the Chinese economy. And why is that so? The Chinese property is the sector represents about 25% of the Chinese economy. So that's very significant, and it not only impacts the developers, it impacts down other upstream sectors like steel, cement, glass, and so on. And on top of that, all these industry employs a lot of people. And of course, if residential sales and volumes and it's not stable, then it also could impact consumption as well. Now, we had a difficult 2022 where sales dropped quite sharply, but we think that with all the policies in place, our forecast is that 2023 will see a better year for residential sales. And this is essentially supported by the various policies that we have seen coming out from the Chinese authorities. So one example, as I mentioned, was the 16 measures, which was issued in November. So let me highlight some of these things. First is that they're rolling over existing developer loans. All right. And then they are supporting also property sales through lower down payment and mortgage rates. Other things as well is boosting other funding channels. That includes bond market, trust products, and so on. And I think finally, but not least, is ensuring the delivery of pre-sold property. And this is mainly to address the large number of uncompleted properties. And as you see, as you might have also noticed, in the first half of last year, there was a lot of protests by buyers in not servicing their mortgage, and this is to basically address that issue. So in sum, the policymakers have told banks to support the property sector, and this is basically a U-turn from the three red lines tone of deleveraging that was set 2 years ago. So it is no longer politically incorrect for financial institutions to increase exposure to this sector. So with China's economic recovery for 2023, we think Asia's GDP growth will exceed the developed markets. So as you can see here, the Asia ex-Japan GDP growth represented by the blue bar, it's significantly higher than the rest of the regions. And so this will bode well and is supportive of the risk assets here in Asia. Another thing that has happened lately, if you've noticed, is that the US dollar has also peaked. And why is this significant? And as you can see here, the dollar index, right, inverted, all right, is highly correlated with the MSCI emerging markets. So when it turns down, right, generally the EM index moves up. I'm using EM here because EM is a strong is a proxy for Asian markets. And so with that, it means that the US dollar is seeing the weakening US dollar basically indicates that there is easier financial conditions as well as possibly stronger fund flows into the region. Okay, so Asia, we expect rather, that it will outperform the world in 2023. And this is predicated on three factors. One, the EPS growth is higher in Asia versus the rest of the world. The US dollar index direction should be either flat or weaker. And in this case, it has already weakened, right? And the Chinese manufacturing PMI is above 50. And we expect for this year, EPS growth will be higher. If US dollar to be somewhat weaker, Chinese manufacturing PMI to be somewhat above 50. And if you look back in the table below, you can see that every time this aligns, Asia tends to outperform. And in this case, we expect 2023 to be no different. So I wanted to show you the flows from the emerging markets risk assets perspective. Now, last year in 2022, we had big outflows in bonds, somewhat better in emerging market equities. But I think if you notice in the inset here is that things are improving at the margin towards the end of last year. And In fact, this year already, I think the indications are fund flows are decidedly positive. And for the rest of the year, I do expect 2023 to be a good year for fund flows into emerging markets and into Asia, especially. Okay, so as far as valuations are concerned, I mentioned that it is relatively cheap. If you look down in the column for PE for 2023, it is now trading at a level of 12 times for Asia ex Japan, or even Asia Pac ex Japan is about 12, or maybe 12.7, which is slightly higher. But this is relative to its history, relative to developed markets, which is at a much higher level of about, I believe, if I'm not wrong, 18 times for the US. For relative to its history, PE for Asia ex-Japan has traded between somewhere around the range of 11 to 15, 16 times. So it is still relatively cheap in our minds. Okay, the other thing that we have noticed is that earnings drives stock prices, and earnings in this case is starting to show positive momentum. So as you can see here, the blue line, Asia ex Japan, it is starting to turn upwards. Okay, so much for Asia. We'll just touch briefly on US inflation. So US inflation has peaked in the middle of last year, right? It's gone above about 8+% and is now trickled down to about 7%. And this has been led largely by three contributing sectors or segments. First, it's transport, which we can see quite clearly by the red line. It has declined very sharply. And then the second one is housing, which is basically rental. And then the third is food. Now we think clearly that inflation has passed its peak. And we'll be supported by the fact that US rentals probably is close to its peak. Now, US, the red line shows rental, which is still rising, but the house prices has started to fall quite sharply, and this is usually quite a strong leading indicators for where rents go. So we could say that rents is likely to be close to its peak, if not peaked already. The other thing that was still rising in the chart that I showed you earlier is that food was still climbing to some extent. Now we think that that has also peaked, and as you can see here, the blue line, which is the grains price index, has also fallen quite a fair bit. And we would dare say that as far as the contributing factor for US CPI, I think this is also on the decline. Okay, this is a US inflation projection that we've made. So if assuming that the CPI grows 0.2% going forward for the next several months, and by the way, we had negative 0.1 in December, we would project that the year-on-year figure by sometime in the middle of this year will be somewhere close to about 2.5% or so. And that is significant because if you follow the Fed closely, one of their targets is to bring inflation down to a level of about 2%. So, so I think that it is quite achievable. Things could see a 2% inflation rate sometime by the middle of this year. And of course, the other thing that is a supportive, well, I would say a supportive factor, but a factor nonetheless in terms of bringing down inflation is that recession is a high probability and is elevated at this point. So this is our in-house recession indicator, and it shows that recession in the US is likely, and with that, investors are expecting that by the first half of this year, right, US inflation, US interest rates, as indicated by the dark blue line here, will peak in the first half and possibly cut towards the end of the year. Even though at this point in time, the Fed's board members or the Fed members has indicated that it will keep raising up to a level of about 5% and then stay higher for longer. But if if the recession comes, it is possible that we could see that the interest rate could be cut towards the second half of this year. So, just before I talk a little bit about our positioning in our funds, these are some of the risks that I want to spell out. Is that we could continue to see persistently high inflation. Another risk is you could see hard landing in the US and Europe. There could be further rationing of US and China tensions that cannot be ruled out. And China's economic recovery is weaker than expected. So what have we done as far as equity fund positioning is concerned? So this is what I do on a daily basis. I'm an equity fund manager, so maybe I'll just talk a little bit about what we have done. So we do favor companies that are basically high in quality. So we like companies with good growth visibilities, with strong earnings resilience, with the ability to cope in inflationary environment, and in the industries where we could be close also to the end of earnings downgrades. And we especially like beneficiaries of domestic demand. And so with that, we are focusing on especially beneficiaries of China's reopening, which I've mentioned earlier. We think domestic consumption will do well for this year. Investment as well, because China is pushing hard on that front, raising funds and pushing infrastructure as a growth driver, and of course, tourism-related names as the borders reopen. We also like selective financials, which are exposed to improving domestic economies, but we will be quite selective on the export-oriented names, given the fact that the developed economies may be facing an economic downturn. So some of the recent changes we have made includes raising exposure towards China, Hong Kong, Thailand, for the fact that they are a big beneficiary of China's reopening. But we have somewhat pared back our exposure towards ASEAN and India, seeing that they have done pretty well in 2022. All right. So with that, I will hand it back to Nadia. If you have any questions, please feel free to ask.
Thank you, Jeffrey. That was an insightful presentation indeed. If you still have questions for Jeffrey, please drop it in the comment box. Okay, I'm taking this opportunity to also share with you our CNY promotion. Grow your wealth and prosperity this rabbit year. Invest with us online and you'll earn up to 0.88% reward. Enjoy 0% sales charge during this offer period for all cash investments. This offer is valid from now until 14th February 2023. Terms and conditions apply. The campaign details can be found in the comment box. Okay. So I guess it's time for a quick Q&A session. You guys can still send your questions in the comment box if you have any, yeah? Okay, so I'll read the first question, which is, the Western media is still saying recession out loud. What do they mean by that? Jeffrey, can you give your opinion? Yes.
So as I've indicated earlier, I think that the momentum for developed markets, whether it is US or Europe, it's on the downtrend. So much of it has to do with high inflation, which led to rising interest rates and very accelerated increase or a steep increase in interest rates. And so with that, we're likely to see somewhat of a pullback in economic growth. Now, whether that leads to a hard recession or soft recession, that is yet to be played out, but our view is that it is likely to be a relatively soft recession or soft landing, if you will. Largely because we at this point do not see any systemic issues in the financial sectors or in any sectors that we can think of at this point. So there will be some sort of a downturn, but we will probably see some stability towards maybe early 2024, perhaps. Back to you, Nadia.
Okay, next question. Would you take the view of Xi's third term as leader of China and the ruling out common prosperity will resist the economy growth derived by the entrepreneurship in the past?
Okay, our opinion is that I think he's kind of doing the right thing. He's trying to do the right thing in that he's being a populist, right? He's trying to address the issue of a very stark difference or between the rich and the poor, right? So that's what he is trying to do and he has done. I think that large part of it has already been done. So now the focus for Xi and his team is really to get China back on its growth path, so that everyone can prosper, whether it is the rich or the not so rich or the poorer people, the population.
Okay, so the next one would be, what would be your view in regards of to bond in 2023?
Okay, I'm not a bond expert and neither am I a bond manager, so I'll do the best I can. We think that in general, interest rates has peaked, and in general, I think that the fixed income will be also a relatively good place to put your money in. It's just that we think that at this point in time, Asian equities being led by China's economic recovery will probably see better upside for 2023.
Okay, this question, I guess this person have invested in Indonesia and Singapore related fund. So the person's asking, what is the outlook for 2023?
Okay, let me start by well, talking about Indonesia. So Indonesia's economic growth is supported by one, reopening, second, commodities, third, I think we are also seeing strong interest in investing in Indonesia by foreign investors. So we are seeing strong FDIs as well. So those are the legs that we are seeing for Indonesia. So Indonesia's outlook is pretty good. The problem for me, as far as Indonesia is concerned, is that last year it had a very good, relatively good year. Relative to the rest of um, the the world, basically. In fact, it's probably one of the best performing markets. I'm talking about equities in the world. And so there is likely to be some shifting of funds away from Indonesia. But having said that, we've seen some correction. We still see a lot of opportunities there. There are good opportunities out there to invest in Indonesia. And it could be the banks, it could be some commodity related place. But Indonesia, I think, is in a relatively good place. Now, as far as Singapore is concerned, Singapore has also done relatively well last year. That is due to the fact that the banks' stocks have done well. And there are also a lot of quality stocks in Singapore. So during a downturn, Singapore tends to be a beneficiary, and that's what has happened. And so again, at the margin, there will be some profit taking. People will be more excited about maybe going to China, for example, or perhaps even buy into Taiwan or Korea, where we've seen it coming down a lot over the past year or past 1.5 years for that matter. So I hope I answered that question. Yeah.
Okay, the next one, oh, you have a lot of questions coming in, so exciting. So the next one is, what is the likely ramification for the ongoing tech war? Would that precipitate a recession? And what is the ongoing strategy by China to counter the US? They put it in the air quotes attacks.
Okay, so yeah, so I think the first part of your question is the tech war going to lead to a recession? Tech wars probably won't lead to a recession per se, but what tech war will do is that in this case, we think that there will be two spheres of so there will be one camp, which is the US-led camp, right? So they will be doing all they can to deny this high-end technology to China. On the other hand, because China has very high ambitions, and so what they will do is that they will put a lot of money, a lot of resources, a lot of effort to try to gain some foothold in the semiconductor space, for example. So they will pump a lot of money. They will have their own ecosystem and they will build it up. The problem for them is that they are coming from a very low base, so they will take some time to catch up. But nonetheless, I think the impetus for them is that they will put a lot of emphasis in pumping money and resources towards trying to to regain some of that technology gap, if you will.
Okay, the next question is still related to tech. Do you foresee a strong rebound of the tech sector, or would it continue to plunge into the abyss? What would be your recommendation if you have a position in tech?
All right. So, tech encompasses many things. I mean, and it's many things to many people. It could be hardware tech like semiconductors or servers and so on and so forth. And then it could be software, or it could be even in some people would say internet is part of tech. Yeah. So as far as so I'll answer in three parts. Well, software I would say I'm it's not an area I'm very familiar with, but hardware tech, as far as hardware tech is concerned, again you have to be a bit discerning. Uh, some of the technology leaders is going through some sort of, in fact, the whole entire semiconductor space or hardware tech is actually going through an inventory correction. And some of it will come out faster than the others. Some of them will gain market share. And so we have to be very discerning. So we do like some of these names because they are quite beaten down. We think they represent very good value. We think they are close, maybe close to the bottom, and likely to see some sort of a recovery by the second half of this year. And so we are quite excited to maybe put in some money in some of these names. So that's one. And if you talk about internet, well, in Asia's case, the real internet companies the big companies are in China, and they've gone through uh, well, a lot of new regulations which have basically dampened their growth over the past 2 years. But nonetheless, I think they will come out of it. I think they will come out relatively strong. And with the recovery in China's economy, I think they will do relatively well. Okay, back to you, Nadia.
Okay, the last question would be, how would a moderate recession in US and EU impact China's economy, and how would that impact the rest of Asia?
Okay, so as far as the impact to China is concerned, I think it will impact them from the export point of view. So as we all know, China is the largest manufacturing hub in the world, and a lot of it goes out towards a lot of the exports go towards developed markets. So we do expect to see some sort of a decline and headwind for this year. But the good thing about China is that it is also very big in its domestic economy, and we are seeing a big recovery. We think we're going to see a big recovery this year, based on the fact that the Chinese is prioritizing growth for this year. They are pumping a lot of money in infrastructure. They are supporting property sector. They are reopening borders. So consumption will be very strong for that. And so I think China will recover on the back of these, even though there's some headwinds as far as the export sector is concerned. Now, as far as the rest of Asia is concerned, again, it depends on whether they have large domestic economies. Like India, for example, they do have a very large domestic economy. And then Indonesia is driven by what I've already mentioned, reopening and so on. ASEAN will also benefit from the reopening in China, where we might see some dampening effect is maybe or impact could come from Korea or Taiwan, where they are very reliant on exports. So those are the areas that we could, or those are countries that could see some sort of impact or negative impact from a possible recession in the US and Europe.
Okay, Jeffrey, would you like to share any closing remarks before we end this webinar tonight?
Well, like I said, I think the market correction is over. China is on the cusp of recovery, and likewise Asia. And I think fund flows is going to help and going to move towards Asia. Valuations are not expensive, or not high, and we would expect a better market in 2023 for Asian equities. Thank you.
Okay, that's all. Thank you so much, Jeffrey. That's all
Thank you
from
very
us
much.
today. Have a good rest, and I wish you a good night. Thank you.
Thank you.